Morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And this week I am delighted to be joined by Leah Bramwell, who is from our Chief Investment Office and is our Head of Tailored Investment Solutions. Morning.
Morning, Jane.
Welcome back.
Thank you.
As you know, we are here each week to try and cut through all the market noise, demystify what's going on, and hopefully you will feel more informed, more confident and more in control of your financial future. So this week, Leah, I wanted to discuss a couple of headlines, but kind of get a little bit beyond the headlines and think through some of the noise that we hear. So this week's headlines have been around falling inflation in the US, obviously a new government, new Prime Minister arriving into Downing Street. But I think one of the biggest challenges for clients, for investors, and even for ourselves as professional investors is knowing which headlines really matter and how we sort of cut through all those headline pieces of noise and really work out what really matters. So let's think about what they can teach us about building wealth over the next decade. So grab your coffee, let's dive on in. So as I mentioned, first of all, we have news from the US that their monthly consumer prices fell, I think for the first time in 6 years, which is pretty good news. So what's happening there?
Yes, as you say, monthly consumer prices fell, driven mostly by a fall in gasoline prices in the US.
Yep.
So that brought the year-on-year rate down to 3.5%, and that core number rising below the consensus expectation, so up 0.2% month on month.
Okay. And the new Fed chair, Kevin Warsh, the US Federal Reserve chair, he's in place now. So what are they making of all of this?
So as we know, Warsh is traditionally viewed by markets as an inflation hawk.
Yep.
So that means that the Fed is likely to lean more towards stability rather than rate cuts, which would be pleasing to the markets. So even with a month of soft monthly data or a couple of months of soft monthly data, the Fed's really unlikely to pivot aggressively. 3.5% is still well above the Fed's 2% target. So Warsh has reiterated on numerous occasions that policymakers don't have any tolerance for persistently elevated inflation. And so we wouldn't expect a month or two of softer numbers, which really is to be expected given the volatility in energy prices to lead to a huge policy shift from the Fed.
Okay, so all sounds like good news. So going back to what I said at the beginning, how do you distinguish between a noisy data point or 1 or 2 months of data versus a meaningful trend?
Yeah, so markets will often react to data points.
Yeah.
Because there's a lot of algorithmic trading that goes on in the markets, and those models can be triggered by headline numbers. So
Right.
a headline that comes out can lead to buying and selling almost instantaneously. And in combination with a very high level of passive ownership in the market, so people who aren't making active decisions on whether to buy and sell, that can lead to short-term volatility around those data points. For longer-term investors, though, the structural factors sort of behind those numbers are much more important. So we really need to encourage our clients to look through that short-term noise, particularly political short-term noise, but also economic short-term noise, to focus on their longer-term aims and objectives.
So I know past performance isn't a guarantee of future performance and all of that, but if you look back over, say, the last 10 or 20 years, what factors have you seen that have generally had the biggest impact on investment outcomes?
So earnings are the main factor that drives long-term returns.
So what
Earnings.
Companies are generating, the revenue they're generating from doing business.
Exactly. So those are underlined by economic growth, by changes in productivity, by innovation and business adaptation, changes in technology, compounding of returns over time. But earnings in themselves, what businesses generate, are by far the most important thing for long-term returns. The correlation between earnings growth and price movements over time, over long periods of time, is very high. And valuation changes, so changes in multiple, which we hear talked about a lot at the moment, what people are paying for those earnings, they dominate the short-term returns.
Right.
But in the long term, it's that earnings growth which really matters.
Okay. Can we come back to compounding in a minute?
Sure.
But before then, just on short term, why do people then naturally gravitate to all of these short term developments when really it's the long term drivers are so much more important?
It's a whole field of research dedicated to that question.
Right. You've got about a minute.
I've got a minute. Why do humans behave as they do when they're considering their finance? I mean, there's a couple of biases.
Because we're just not logical beings, I suppose.
Yeah, people are not rational.
No.
So humans suffer. There's lots of biases, but on this particular topic, availability bias. So overweighting recent news over longer term news or trends, and loss aversion as well. So people feel pain of losses a lot more acutely than they feel pleasure from investment gains. So people are really scared of losing money, and they're not rational necessarily when faced with loss relative to gain. And then there's media doesn't help in the sense that there's 24-hour media available at people's fingertips. There's increased sort of gamification of finance. You see through trading apps and on social media, you can read about trends any hour of any day. And so long-term investing feels a lot less exciting than short-term moves. Why would I be delighted with an 8% annualized return when people are talking about making hundreds or thousands of percent in days or weeks or months? It's much less exciting.
Mind you, I think 8%, if you give me 8% every year forever, that's got to be far more exciting for me in the long term, hasn't it?
Wouldn't that be wonderful? You'd be far better off.
I'd sleep better at night, wouldn't I?
Sleep better at night. And I think, of course, people are a lot less noisy when they're losing money than they are when they're making money.
Yeah.
And so you don't hear about the flip side of when those investments go wrong.
Yeah, a tricky one, I guess, because you are challenging humans' natural, as you say, biases, behaviours. So we touched on compounding, and we've just touched on there about staying invested for longer. So it sounds like identifying great businesses to invest in is only half the challenge. The other half is having the patience to stay invested long enough for that success to show up in their returns. So why is patience such an important but often overlooked investment skill? And I guess that relates to the importance of compounding returns over time.
Absolutely. So you've touched upon one of the wonderful hidden mysteries, secrets, underlooked things within finance, which is the power of compounding.
We love a little secret here.
It's the most wonderful thing for investors.
Okay.
Because you just have to sit and watch your money grow over time. And the idea is that if you have invested a pot at the beginning and you're getting an interest rate or return on that pot at the beginning, that each year your return on that pot grows because the pot size has grown. And if you look at the numbers on how that works, it is a wonderful chart, and it's really worth having a look into a power of compounding table for our readers. There's a great book about compounding. It's Rich Dad, Poor Dad.
Okay.
And there's a table in there which shows that if you invest early in your career and you leave that money invested and you see it compound over time, you have to invest far, far, far less over the course of a lifetime than if you've left it later on in life. So the sooner that you can start the better. So power of compounding is a really, really important financial concept for all of our listeners to get on board with.
Do you know that's really spooky, because that Rich Dad, Poor Dad has just popped up into my, I can't remember, it was my podcast on my Audible algorithm feed this week. Spooky. Must be a really important subject. They must be hearing me.
It was the one financial book that my parents gave me to read as a child, and I pass it on to everybody I know because it's one of finance's most important lessons, and it's so overlooked.
And my other book club recommendation this week is the Psychology of Money. Morgan Housel.
Yes,
have you read that?
Also a great book, and he covers compounding.
Yeah, he does. Yeah,
and some of the things we've been talking about on behaviour as well, behavioural finance. So really accessible book and really interesting read.
Okay, new Prime Minister moving into number 10. So I think we're also all keeping an eye on the new chap in number 11 as well, and what impact that might have on the markets. So when governments change, I think it's just natural for us all to focus on the names. But what really matters more to markets, is it the people in the names, or is it their policies, or is it just about having greater clarity about the future because markets just dislike uncertainty, or is it kind of all of the above?
Yeah, all of the above, Jane. Markets will automatically be pricing in an uncertainty premium. And
Because there's a change of regime.
because there's a change of regime. And
Yeah.
I mean, that's the case in any country, in any political environment. There'll be some level of uncertainty premium. What really matters more to investors, not the identity of the new prime minister or the new chancellor, is how predictable their fiscal path is. So what their spending plans are, and how predictable those spending
And we're
plans.
still waiting to hear a lot of that at the moment.
Yeah, but I mean, gilt markets react very, very quickly. So markets are not looking at what Andy Burnham is saying in his political speeches. They're looking at the gilt curve, and that reacts very, very quickly to changes, and they will react very quickly to any borrowing plans if they're perceived as reckless. And we've talked about this in the past about bond markets holding politicians to account.
Yeah.
We've seen that in the very recent past in this country. So investors will be more focused on that, I would think, than the political noise.
Thank you very much. I think it's probably time for me to sum up what is in my Canaccord takeaway coffee cup this week. Really interesting. The headlines were about inflation and politics. That inflation data can move markets for a day, that political developments can dominate headlines for a week, that market sentiment can change from month to month. But underneath all of that, I think we're saying there's the same lesson, one lesson we should be learning, that investors are often rewarded not for predicting every twist and turn, but for focusing on what genuinely drives long-term outcomes, and that long-term wealth is generally created through economic growth, through business success, and the power of compounding over time we talked about. I would say if you were an investor, invest in patience. That would be my top tip, because I am not a qualified investment analyst, obviously, but it sounds like a good thing to do to me.
It's a great top tip, Jane.
Thank you. Anyway, thank you, everybody. Thank you for listening to the Canaccord Coffee Break podcast today. We hope you've enjoyed it. And don't forget to hit follow on your preferred podcast channel of choice, and you will never miss an episode. And as always, we'd love to hear your thoughts. Ask us any questions. If you want to know more about the power of compounding and investing in patience, drop us an email, coffeebreak@canaccord.com. Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.